That's what's happening on 95% of it. And the lender looks at it and says, well, if you buy an interest rate cap and you pay us the extension fee, I'll give you another year. Because I actually don't want the property back right now. When I talk to banks, they don't want the property. The only time they are forced to take the property is you stop paying. So you as the borrower don't have an interest rate cap, or your property is not performing and you just cannot sustain the interest rate that it currently is at. Combination of bridge loan plus don't have money for interest rate cap, then those people are selling right now and it is at a loss. In 21, there was like 50 to 60 deals in DFW on the market at all times in 2021. Like right now, there's probably 5 to 10. So you're probably 5 to 10% of the peak right now in terms of deals.
So in the multifamily space, though, if we go into a recession, and that is a reason why interest rates drop, are lending standards, do you anticipate lending standards tightening?
They've already tightened.
I've got the one and only James Ang today. James, thanks for coming on, buddy.
No, I appreciate you having me. I mean, it seems like the world of multifamily never stops changing. So we always have something fun to talk about, whether good or bad, right? So
it's gonna be a great show. We were actually reminiscing before we came on that I've known James for probably 7 or 8 years. We met all the way back in the early Brad Sumrock days on I think a bus tour or something, and that's how we met. And now you're like the national director for Old Capital. That's crazy, man. Congrats.
yeah. It's been, I mean, Dallas is like the epicenter of multifamily, if you want, for better or for worse. So, it's been a crazy the last couple of years. And, now I guess is really just the beginning of a new cycle. I think that's my new, August webinar is going to be the beginning of a new cycle. So.
And I'll get to my first big question. I know you have a great quote that I want to quote, but for those of you who don't know, you just spent a couple minutes here. Obviously, you're in the multifamily space, but
Sure.
Tell me a little bit of what you guys are doing, what Old Capital does, and a little bit about your background.
Yeah. So I was born and raised in Houston, went to school in Austin at UT, and then coming out of school, I had no idea what I wanted to do. So I worked at G Capital, basically in their finance rotational program. And they put me up in Connecticut. They put me in Denver, looking at financing like IT servers. And then I came to Dallas and actually got to work in their real estate group. And that's when it like sort of clicked that I was like, I need to stay here. So I just sort of stayed in that group. I was the youngest person for the first like 7-8 years of my career because everybody there had like 20-25 years of experience. So I was just like the young guy who was sitting next to all these experienced underwriters, and we were doing bridge loans, so balance sheet bridge loans for GE and CMBS loans. And so that's sort of how I got into the space. And then in 2015, GE was, basically shrinking their entire financial service portfolio because they really couldn't compete with banks, because banks' cost of funds was 0 and our cost of funds was 5. So you can only do that for so long. And GE was like, I'm done with you guys. We're going to sell you. And guess who they called? They called Blackstone. And Blackstone was just coming up at that point. And Blackstone, they basically looked at our entire $80 billion portfolio. And in 30 days, they closed $80 billion of real estate in one fell swoop. So that was great for Blackstone. Not so good for me. They basically just said, appreciate you guys all being here for 10 years of your career, but we don't need any of you guys. And so I went off and joined Old Capital. I had met Paul Peebles in 2014 when I was looking at doing real estate. And so since 2015, have focused in on multifamily financing and then investing in deals along the way. And so that's really my background getting into the space.
Awesome. And I definitely have a bunch of questions about bridge loans, but let's start with this, man. The internet is, as you know, is full of talk about doom and gloom in commercial real estate. But you recently had this great quote that said, this is a once in a decade opportunity. Why do you think that this is where we are in the cycle right now?
Well, I mean, so if you look at where prices were in 21 and 22 and where they are today, they're essentially probably 30% below sort of where you were at the peak. And do you think it's going to drop another 30%? Probably not, right? So we're seeing pretty much values flatten out right now, especially on the A stuff, a little bit on the B stuff. I would say the C stuff hasn't traded as much, but definitely on the A stuff. If you listen to the top REITs, like whether it's Camden or MAA, Equity Residential, like these guys who own 50 to 100,000 units, they're basically calling a bottom right now. And they're really just using like 5%. 5% cap rate is really the number where everyone sort of comes back into the market. And so that's where deals are penciling. That's where debt, you can get it to 5%, or you might be a little bit negatively levered. You might be 525, 550 right now, but people are willing to accept that because in the next 12 months, the supply is super heavy right now, especially in sort of your Sunbelt market. So we're seeing negative lease trade outs right now, and people are expecting that for the next 12 months. And then sort of back half of 25, 26, the supply is supposed to basically drop off a cliff, and people are expecting rent growth to come back. And so they're willing to sort of accept that negative leverage right now. And then once the rents come back in 26, 27, you're going to be in a lot better position because rents are going to be higher. And then also the thought is cap rates are going to be lower. So
Why is supply going to drop in 25, 26? Is it just like
yeah.
you can see that because of the permits being pulled and the construction's not there?
Yeah. So in 21 and 22, so let's say in Dallas Fort Worth, in 21 and 22, there was like 50 to 60 deals on the market. Okay. And when you went and bid on a property that was 200 units, there would be 50 people who would do a tour. There'd be 40 offers on that deal. And then there'd be best and final. There'd be 20 people in best and final. Then there'd be a best and final, the best and final. Then there'd be 10. And then it just go up and up and up and up and up. And then the deal started at a 5 cap. But then with all the increases in pricing, it eventually got to a 3 cap. And so the person who started looking at that deal, only one person won that deal. The other 39 people lost on that deal. So guess what they did? They said, well, I can't buy it, so let's go build it. And so they did construction loans, and they were able to raise equity for new construction in 21 and 22 to the nth degree. Like there was endless money. And so all those deals are delivering now because it basically takes 2 years to build it and a year to 18 months to lease it up. And so all that stuff is hitting right now. So I think if you look at Newmark just had a good report. Typically in a quarter, there'll be, let's say, 80,000 units delivered across the nation, a multifamily. This quarter was like 160,000.
No.
Next quarter, like 180. Next quarter, 200,000. So in 2024, there's going to be like 550 to 600,000 units delivered on the ground, where a typical year is 300.
Wow.
And so it's just like the amount of concessions that people are having to give right now on new stuff is like 2 months. My sister just signed a lease in Austin, 2 months free. And this is just like a normal, suburban Austin deal. And that's the only way you can get people to lease. And so, but then what happened is, it's like a pendulum, right? And once they started raising interest rates, to the end of 2022 and 23, there's no money. The interest rates are going up. People are getting nervous. You can't raise equity, and the bank is lending out at 8-9%. So in 2023 and 2024, nobody's starting a construction project. Like these large REITs they have like $1 billion in cash. They're not even starting. Like Camden started like 2 properties this year total, like 700 units. That's it. So in terms of, that's why people see sort of 25, 26, 27, that if you didn't start in the last 2 years, like nothing's going to be delivering in 26 and 27.
Yeah. Yeah, don't forget also a lot of folks, the construction side, inflation was just driving up construction costs, whether it was labor,
Cost of it.
materials. And so that also had a huge impact to, um, if you guys have your questions, drop in. I already saw Paula drop one in there, and a couple of folks here pre-submitted questions. I'm going to get to those first, but let's talk about the elephant in the room. You mentioned it briefly, but I've been saying for a long time that, multifamily in of itself has actually held up pretty well, especially on rents. The cause of pain is really obviously interest rates, right? The debt piece is the thing, and part of that has also been the bridge loans, like people
Yep.
that just were forced to go into the bridge loan world because things weren't penciling out back in 2022. Where are we with that? Are we almost done with clearing that from the books, or are we kind of at the peak of that? Like, where are we with these bridge loan debts that are coming due? Let me start with that question. Tell us where we are in that environment.
So let me and I don't know where people are at, but let me just explain why so many people took bridge loans in 21 and 22. And and it goes back to the competition and the number of people bidding on these properties. So if you take, let's say you took a $10 million deal that was on the market, and that's the whisper price. Okay, $10 million. And you come to me and you're like, hey, can I just get like a normal agency loan at 3% or 3.5%? I'd be like, yeah, no problem. Here's your quote. I can do 65%. It's a six and a half, $7 million loan. Okay, great. Like I'll pay $10 million for that deal all day, right? The problem is that that deal would get bid up from 10 million to basically 15 million, and then all the way up to 20 million. And now you come back to me and say, hey, this agency loan, can you, I got to pay 20 million on this deal now. And no, agency's like, no, we're not, it's $6 million. So your leverage would have been like 30%. And so they would say, all right, is there any other lenders besides these agency lenders? And I'm like, well, there's this bridge guy, and he's going to do 80% of your purchase price and give you your rehab. And you're like, well, that sounds pretty good. What's the risk? Well, it's floating rate and it has a 3-year term. Okay, well, the Fed is saying they're not raising interest rates, so that's not a problem. But then 3-year term, yeah, I'm going to sell this deal in 12 months and I'm going to double everybody's money, so it's not going to be an issue. So all those like factors really drove the amount of bridge loans that were done in 21 and 22. Previous to COVID, we would do a bridge loan when it just didn't qualify agency. Like either there was a lot of crime, there was a lot of capex that needed to be done, the borrower couldn't qualify. There was all these reasons that we would do the bridge loan, and you paid a higher interest rate for that. But the bridge loans in 21 and 22, it was a lower interest rate and a higher leverage. And so everybody took it. And now what happens? All right, so now so we did all these loans in 21. They're coming due in 24. So everyone's thinking this is the reckoning. Like these guys, there's no way they can refinance out of these deals. We already said values are down 30%. So they're going to have a huge pay down, right? And what's happening in reality is that they are going back to the lender and saying, hey, I know it's a 3-year term, but we had 2 1-year extensions. Okay. I know I don't qualify based on debt service coverage or debt yield, but can you just give me 1 more year? And the lender looks at it and says, well, if you buy an interest rate cap and you pay us the extension fee, I'll give you another year because I actually don't want the property back right now. And so that's what's happening on 95% of the deals. There is a 5% where the lender's like, well, in order for you to qualify for the extension, I needed a 125 debt service, or I needed a 9% debt yield or 8% debt yield. And you need to pay it down by $2 million. And so some lenders are putting sort of the borrower's feet to the fire a little bit and saying, hey, if you don't do this, like we're going to foreclose on you. But that is a very, very small percentage. And then some people are running into the issue where, okay, you need to buy an interest rate cap because now when we started, it was SOFR plus, let's say 3%. So SOFR when you started was 0. and 3% was 3. So now you were paying 3% in 2021, and now you're paying 8%. And so you almost have to buy an interest rate cap because all these deals were done at cap rates of 3 to 4. So unless you've just increased your rent significantly without your taxes or insurance going up, your NOI is up a little bit, but it's not up that much that you can pay double or triple the debt service. So right now, if your lender is not being flexible, or if you do not have the money to buy an interest rate cap, those are the people who are selling right now. So that combination of bridge loan plus don't have money for interest rate cap, then those people are selling right now, and it is at a loss. Most of the people are trying to kick the can for another year, though.
Yeah, and Chris was asking about this loan modification. I know you're on the call, Chris, but it sounds like these are not modifications. These are just the bank is extending the loan, so you're keeping that low interest rate from 3 years ago. Because with a modification, I presume the interest rate would kind of, reset at whatever it is at current markets.
So what is being modified is that you do not currently qualify based on the original loan agreement,
Right.
because of debt service, because of debt yield. So it is a modification to the loan to get that extension. And most lenders are not requiring a huge pay down, though, right? They just want you to buy the interest rate cap, pay us the fee, and everything's going to be better in 12 months. So like us as the lender and you as the borrower, everything's going to be better in a year. So just kick the can one more year and it'll be easier.
Yeah, kick the can down the road seems to be the way to go. But they're still requiring you to get an interest rate cap, right?
Cap.
And this is an
Correct.
issue that I've heard a lot. We talk about it actually on my other show, Drunk Real Estate, a lot, where even when people are doing okay and they're anticipating an issue and they go out and say, okay, well, let's negotiate an interest rate cap so we're protected in the future.
Right.
Lenders are still requiring you to escrow that money so that they're assured that you have it when the payment is due, right? I mean, so there's still a requirement that you've got to bring a ton of money because interest rate caps are not cheap.
Right.
That's still forcing cash. That's really what's forcing the cash calls, right? Right now.
Yes.
On the syndication side. On the syndication side.
So yeah. So there's two types of cash calls. One capital call would be, all right, I got a bridge loan for 20 million and my Fannie loan right now is 17 that I qualify based on current rates. And so if I do a capital call for 3 million, really you're paying down the bridge loan to get to that agency loan. So it's a cash in refi. So that's one type. And so a lot of the refinances that we're doing right now, that's how they're happening. The second type is, okay, we're not close enough to agency. Maybe agency is $5 million away. So that's just too much money. So I'm just getting an interest rate cap. Typically it's about 2 to 3% of the loan amount. I'm buying that interest rate cap for 1 year. And that's allowing me to live for another 12 months. So yeah, if you don't have the money at the property level to do it, and the general partners can't put the money together, then yeah, you're gonna have to do a capital call to get that money.
How far away are we from the agency coming back into play? Because obviously a big piece of that is the debt service coverage ratio, which is one of the reasons they couldn't get their agency loan back in the day.
Yeah.
But you just said earlier that rents, because of all the supply, rents are struggling. And so when does the debt service coverage ratio come back into play where people can actually start getting agency debt again? I mean, is that the 5 cap?
No, people are doing agency right now.
But at like 20% LTV. Like
no, not right now. Right now. No. So like if you buy at a 5 cap and you go get a loan at 5.5%, let's say that's an A deal, right? Then your leverage is probably going to be like 55 to 60%.
Right.
You can still do that deal, right? You have to raise 40% to do that deal, but that's usually an A deal. It's a higher sort of quality building. If you go to a B deal and you buy on a 6 cap and your rate is 5.5, then you start creeping up in the 65, 70% leverage. And then if you buy a C deal, if you get that at a 7 cap and your rate is 5.5, like you're 75, 80% levered. And so on a majority of the acquisitions that we're doing right now, they are using agency because the rates are favorable. It's 5.5 to 6 on most of these deals. Um, the refis are where it's a little bit more challenging just because your leverage on your bridge piece was so high at the beginning. So a lot of people who did bridge loans that were at like 60% levered with a lower spread, they've been able to refi Fannie and Freddie no problem. It's just the people who did 80% plus capex, those are being challenged to refi all the way to agency.
Got it. Got it. Winston says that it's a statement or a question. Multifamily seems to be one of the classes of real estate where banks aren't afraid to take the properties back compared to others like retail, commercial. Do you agree with that? Are you seeing banks taking it back, or are they still, they don't want it, they don't want to
So
repeat of '08 and get all these properties on their balance sheets?
so when I talk to banks, they don't want the property. The only time they are forced to take the property is you stop paying. So you as the borrower don't have an interest rate cap or your property is not performing and you just cannot sustain the interest rate that it currently is at. And so we've seen foreclosures in every major market in Dallas, Houston, Austin, San Antonio, every market there's been foreclosures. And it usually came down to they didn't have an interest rate cap and they could not run their properties at 90%. Like a lot of these foreclosures that are happening, it's 70, 75%. And, there's no money to pay the debt service. And a lot of these properties are just too big. The general partners don't have the money to take them back or to support them for that long.
What are you seeing on the interest rate caps today? Like if you're originating a brand new loan, which I know there's not a lot of that going on right now, but if you were to originate a new loan, what's the feeling out there about, do you need an interest rate cap? How much? What does that look like right now?
It's almost required. So if you go to like Chatham, CHATHAM, Chatham interest rate calculator, you can plug in loan amount, what you want to cap SOFR at, your strike rate, and then that'll give you a percentage. And so for a 1 year cap, it's about 2.5% at a 2% strike. And then it goes to like 4 and then 5. So it's about 5% of the loan amount that you pay upfront at close to get a 3 year cap today.
Cool. If you guys have questions in the chat, drop them. I've got my selfish questions here. And I also do want to talk about the Old Capital Conference. I know it's coming up in October. So definitely want to talk about that. Let's talk a little bit about transaction volume, because that's something that's near and dear to my heart as a syndication firm.
Right.
It sounds like that's one of the reasons why I think we're having a hard time getting price discovery, especially cap rate discovery, because there's just so little transaction. You were actually telling me before we came on that your business is primarily now refis and very little originations, where back in 21, 2022, it was flipped.
Yeah.
So
on acquisitions.
where are we on that transaction? I mean, is it still pretty frozen, or do you see signs of it thawing and the transaction volume getting a little higher?
Yeah. So I talked about in 21, there was like 50 to 60 deals in DFW on the market at all times in 2021. Like right now, there's probably 5 to 10. So you're probably 5 to 10% of the peak right now in terms of deals on the market. And, there's still off market deals that people are trying to shop and things like that. But in terms of like listed deals on the market in DFW, which is like almost the most liquid market in the nation, you've got like 5 to 10 deals on the market right now. So it's got a long way to come back in terms of transaction volume on the acquisition side. And in terms of loans originated, the last quote that I saw was really like the first half of the year across the nation. It was really similar volume to like beginning of 2015. So it was, the last almost 9 years, we had a better start in the first half than 2015. So it's been pretty light.
What's going to bring transaction volume back, though? Do you think that if the Fed, that's a big if, I still say if the Fed does start to pivot and does cut rates, I mean, let's face it, they might not cut at all, but even if they do cut, they might just cut 25 basis points.
Yeah, it might be 25.
Is that going to move the needle? Is it going to move the needle, or is it going to move? Is it mostly perception and okay, now we've hit the bottom, now it's time to come back in the market? Like, what is it going to cost for people to come out and start freaking buying again?
So the 10-year treasury, I think, is more important for a lot of people right now in terms of underwriting deals with positive leverage. So if you look historically, you typically want about 150 basis points between your cap rate and interest rate. And right now it's negative or zero, right?
Right.
And so if 10-year drops to, let's say, 3%, and then your cap rates are around 5, then and you might have a spread in there of 100, 150 basis points. So that's really where you want to be, is having that positive leverage spread. And when you don't have that, like, buyers are not eagerly anticipating to go back out. Number one, because the equity is hard to raise, right? So if you're buying at neutral or negative leverage, your cash on cash is like 3 in year 1 or 4 in year 2. And so it's hard to raise money when, the federal funds is at 5 and you're getting 5% on your cash sitting in the bank. So it's a combination of people actively wanting to get out there, but then also being able to raise the equity when they go out to their LPs.
What happens to lending standards if the 10-year drops, meaning mortgage rates drop?
Right.
Cool. But let's say that's because we enter into a little bit of a recession or maybe a severe recession. Does that affect the lending standards? Because I remember back in 08, interest rates dropped to 0.
Yeah.
Yay. But yeah, good luck getting a loan back in 08. You needed,
Right.
even if you had a 1200 credit score, you weren't getting a loan. So in the multifamily space, though, if we go into a recession and that is a reason why interest rates drop, are lending standards, do you anticipate lending standards tightening?
They've already tightened.
Okay.
And they've tightened, especially so on the Fannie and Freddie side, they have tightened significantly since 21 and 22. And I don't know if you've covered this this group, but basically, Fannie ran into a problem where a investor bought a deal for $75 million approximately, and told Fannie Mae, "Hey, I'm buying it for 100 million," and falsified all the documents, and then got a loan for 75 million from Fannie Mae. Fannie Mae did not like that. And so they've essentially tightened the screws on everybody. So we've seen the amount of due diligence increase significantly on, making sure that every tenant is there, making sure every financial document is there. I mean, at GE, we used to do this, and I was surprised when I came over in 2015 that Fannie and Freddie didn't do this, but we used to do a cash audit. Bank statements, look at the rent roll. All right, you're supposed to have 30,000 coming in a month. Look at the bank statements. I should see plus or minus 30%, 30,000 on that sheet, right? And Fannie and Freddie, they really didn't do that in terms of checking seller statements and things like that. So Fannie and Freddie, they're going to have to deal with some of those issues, and so their underwriting is tightening. I would say on the bank side, their underwriting is tightening, just in terms of making sure your relationship with them is stronger. So Fannie and Freddie don't require deposits, but banks require deposits to come with you, and it could be 10 to 20% of the loan amount. So it's a pretty high requirement, and you're signing recourse on those deals as well.
James asks, what exit caps are buyers underwriting to? Which actually leads into one of my other questions, which you do a ton of underwriting content. I see a
Right.
lot of you do not live, but you have a lot of case studies where you look at a property and you go through underwriting. So if you guys haven't checked out James's YouTube channel and you want to learn about underwriting, that's a great place to start. Obviously, because it's from the lender's perspective too. But I was going to ask you to give us like an underwriting masterclass here in less than 5 minutes. But
I can
exit
do it,
caps, exit
Mauricio.
caps,
I can do it, no problem. It's so
exit
okay.
caps is
So
all.
yeah,
Go ahead.
yeah,
Sorry.
yeah. So okay. So exit caps is probably one of the most complicated things for people to explain, but let me try to do it. So we talked about cap rates and people buying Class A deals right now for 5% cap rates. And so that's their in place going in cap rate. Most people hold deals for 5 years. And the standard across the industry is really to add 10 basis points a year to your starting cap rate and use that as your exit. So if you're buying a deal at 5, you should use an exit cap of 5.5. And the same thing goes for a B deal. Like if you buy a B deal at 6, you should use a 650. And so that's pretty straightforward. What people start doing when they want to be a little bit more aggressive is, okay, you know, I'm smarter than everybody, and I think exit cap rates are going to be the same as what I'm buying at. So 5 years from now, I'm not using a 5.5, I'm using a 5. Or I'm even smarter, I'm using a 4.5. And if you buy, so what happened between probably 2015 and 2019 is that cap rates went down every year. So a lot of people who bought C-class properties at a 7 cap rate, they used a 7.5 cap. But guess what? They sold at a 5 cap. And so that makes every pro forma look amazing. But now in 21, it went the opposite direction. You bought on a 4 cap, and now you're having to sell at a 6 cap. And no matter what you do, it is very difficult to overcome that. And so that's why there's so much hesitancy and sort of negative, I don't know what the right word is, negative sentiment in coming into multifamily right now is that, okay, I'm using it, I buy it at 6, but what about it goes to 8? Because I just saw it go from 4 to 6. Now, if it goes 6 to 8, now I just lost another $100,000. So the quick math, if you want to underwrite a property in 30 seconds, is basically take the rents, take the average rent, times it by the number of units, and add maybe, let's say, 10% in other income of that number, total it, and then divide it by 2 for Texas. It's about a 50% expense ratio, and then cap that at a 5, 6, or 7, A, B, C, and that's your value. So that's the quick math on underwriting. But at GE, I had to underwrite every line item on the revenue side and the expense side and have a detailed explanation on why I underwrote that number. So if you want to do that, you can definitely do that as well.
Yeah, and that's something I actually, for our clients anyway, I like to mention that where when you're trying to figure out the exit cap, it's not a bad idea to do kind of a sensitivity analysis. In fact, if you're a broker,
Yes.
if you're a licensed broker dealer, which nobody is, they're required to do that. So they can't just be like, oh, we think it's going to be worth, we're going to exit at a 5.5 cap or a 5 cap. They would literally say, if we exit at a 4.5 cap, this is what it would look like. If we exited at a 5, it would look like this. And if it at a 5.5, it would look like this. That way you give a range. And
Right.
just from a securities compliance standpoint, makes it easier for you because it's like, hey, I didn't say we were going to sell it at this price. I just said it was going to be at a particular range. But that's fascinating. You guys got questions? Just drop them in the chat. I'm going to keep going here with mine. There's a lot of new folks on the call too. I don't want to assume everybody's been like, an experienced stuff, but like if you're just getting started out and you are looking to buy your first multifamily, how do you go about finding a broker like yourself? I mean, is this a relationship business? Like what am I doing to find a broker? What questions should I be asking a broker if I'm trying to get into a relationship with one?
Yeah, I mean, let's talk about on the lending side because there's a lot of team members that you need to get your first deal done. But on the lending side, the first call that you really have with a mortgage broker or a lender is they're going to ask you for 2 things: your personal financial statement and schedule of real estate. And to qualify for these loans, so let's say a Fannie Mae loan that's $5 million, you need a $5 million net worth and you need 500,000 liquid. So a lot of people, they don't have that. And so they've got to partner with a couple other people to get to that number so that when you're going out to try to buy a deal and you reach out to the listing broker who's trying to sell a deal and they're like, well, do you qualify for a Fannie Mae loan? You're going to be like, I don't personally, but my team of 3 guys can qualify for this loan. And you can reach out to James. He has all our financials and he can show that we're qualified. And so from the lending perspective, that's probably number one is you don't want to be making offers on $30 million deals when you don't have the experience, you don't have the net worth and liquidity. Like brokers aren't going to take you seriously. So you really have to start, $3 to $5 million and then sort of work your way up from there. With a smaller agency or bank loan at the beginning, and then build your way up to the 10 million, the 20, $30 million deal.
Awesome. And then currently right now, do you make recommendations as to the loan product? I mean, what are you recommending these days for people to actually get? Is Fannie and Freddie the only way to go? Is it bridge loans? Is it
So I would say if you're starting on the smaller side, like 1 to 5 million, we usually start with a recourse bank loan if you have no experience. And if you're buying like a 12-unit property, for you to go through the paperwork of an agency loan, you're going to go crazy for 12 units, and the seller's going to go crazy, right? So if it's a smaller loan, then you probably start at a bank loan, which is probably they're essentially priced at prime. So prime's 8.5. So you're probably going to pay 8.5 to 9%, right? And that's going to be your first deal. And then as you get a little bit bigger, the deals are maybe third party managed. So let's say 50 units. Then that's when you start going Freddie small balance or Fannie Mae. And those are probably 1 to 7 million in that range. And then Fannie and Freddie can go up to 100 million. But then if you get, all your Fannie Freddie experience and now you want to take on a heavy value add project, then that's when you would go sort of non-recourse bridge. So we look at the property, we look at the experience of the borrower, and it's going to go into one of those buckets more than likely.
I know that I read that Fannie had come up with this new program, it's like a 5% down payment or something. Is that for relatively small multifamily? Is it like
I
triplexes
don't
and
think
fourplexes?
I think that's more residential.
Okay.
So 1 to 4 unit.
Yeah.
But yeah, on commercial sort of 5 units and above, they're really looking at what can you cover debt service coverage wise to give you this loan. And they need a 125, which is essentially if my debt payment's 100,000, I need NOI of 125,000 to cover this amount with some cushion. And that's how I'm going to determine if I'm going to give you the loan.
I've also been listening or hearing that a lot of institutional investors are coming back into the market. These are obviously sort of the Blackstones or the
Oh
big
yeah.
players that are literally buying, 100,000 units or whatever. Are you seeing that? Are you seeing the institutional players back in the market after sitting on the sideline for a
For
while?
sure. For sure. So Blackstone just took a REIT private, and that was like $10 billion. KKR just bought like $1 billion, equity residential, another $1 billion. In 2023, there was none of that at all. And so just in the second quarter, there was like 4 deals of size that like basically propped up the whole market. Like there was all these small deals, but then those 4 or 5 deals and these were portfolios not just in one city. This was across all markets, national portfolios. And so they are back, but when you listen to their calls, they basically bought all these deals at 4 to 5 caps. So they are back in the market, but a lot of people could not raise equity on a 4 cap deal.
Right.
They need a 5 to 7 cap to make it even close.
Yeah, if you go back to one of my earlier episodes, I interviewed Ken McElroy's chief investment guy, Charlie, and he was saying, the institutional guys back then, they were just trying to shore up their balance sheet because they're just taking a bath back there. But he was starting to see them. This was about a year ago. They were starting to see them come back in, but it sounds like they're now,
They
full.
put
And by the
money
way,
down now. Yeah.
yeah. And what's funny about these institutional guys, by the way, they're all doing 506B deals, which is always fascinating to folks. Everybody thinks that, they're all accredited. They're big guys. They'll be doing some other exemption, but they're all using 506B deals. Paul was asking that based on how we are in the economy, is there a benefit of being a signer on a loan right now? Or does it just depend on how large your portfolio is currently? Any pros to being a signer on the loan?
It depends what you want to do. Let's say you have no experience and you want to get quote unquote Fannie Mae or Freddie Mac experience, I would want you to be involved. Like I don't want like Paula, I think you're in Austin. If you're looking at a deal in Seattle or Phoenix or Jacksonville or wherever, and you're like, hey, should I sign on this deal? Probably not, right? But if there's a deal in Austin that makes sense and that you're going to be a part of the management and you're going to help sort of asset manage that deal, then I would say, okay, that makes sense for you to sign on because you're going to be more involved, right? Like I don't want people signing on loans that they don't have any control, they don't have it takes them 3 hours or 5 hours on a flight to get there. Like that's where people get in trouble, is that they sign on deals all across the nation and they're sitting in Dallas and they never see the property except once a year, or and that's where people get in trouble, because Fannie has a list called A check, and if you're on that list because of a deal that isn't performing well, all of a sudden you can't do your own deal. And so the benefit to being on a Fannie Mae loan is that that shows that you're experienced, that you can do your own deal. But if you get on the wrong side of Fannie Mae or Freddie Mac, then you're not going to be able to do any more deals. Yeah.
Is that because that's one of the issues, right? Like if you end up like all these guys that are ended up in foreclosure right now,
Yes.
yes, they lost the property. Yes, they're probably in a world of hurt if they have investors, but
Yep.
also the chances of them getting a loan in the future with an agency is it zero, or is it just going to take a while, or are they done?
Very close to zero.
Wow.
Uh, so
Wow.
what you're seeing right now is, for people who can't get agency, they're going CMBS. So CMBS is commercial mortgage-backed security, and it works in the same way that CLOs worked. So collateralized loan obligations, which were what these bridge loans were done in 21 and 22. So basically, somebody puts together a 20 million, a 40 million, and 60 million, and they add it up to $1 billion, and they take it out to the market, and investors buy tranches of those loans. So CMBS works the same way, except CMBS is supposed to be done on the actual numbers and not on a pro forma. And then also CMBS is longer term. So it's like 5, 7, 10-year paper. And so those loans are longer term, whereas the bridge loans were only 3 years, 3 to 5.
I was looking at my questions here, and I think we answered all of them, but I think maybe there's part of Chris's question is when we're talking about the loan modifications or the extensions or whatever, is there a common thread of what's being modified or what's being extended, or is it just it just depends on the day the banker wakes up and what the balance sheet looks like on their end?
So most of them, if you've been paying your payment the whole time, then they typically just give you the extra year, right? And say, hey, buy the interest rate cap, pay the extension fee, we'll give you an extra 12 months. If you haven't been paying, that's when they're a little bit like, if we give you the 12 months, can you even make the payment? Right? Like, you're underwater every month, and the bad thing is that all these public companies, let's say like Arbor or Ready Capital, these are publicly traded entities. And so every quarter they've got to report what's your 30-day, 60-day, 90-day delinquency. Like right now, Arbor has $1 billion that is not paying. So if you're not paying, they're gonna I'm not saying they're gonna try to cut a deal, but they're probably gonna make some of your interest current where you have to pay it. Let's say 75% is current. So let's say they'll charge you 6% today, and then they'll accrue like 3%. And because they know you can't pay it, right? So they're modifying these loans to where the property can pay it, and then the rest is being accrued. But with that comes along fees and other things, modifications to the loan, and it's going to cost you more than if you just paid the interest. So,
Do most people hire because this is something that I was looking into. Do most people hire like a loan modification company to help them, or is that something is this a do-it-yourself kind of thing
you
where you just reach
you
out to the bank yourself
can
and
you can it's been hit or miss on whether or not that is materially changing the outcome. If a bank is playing very difficult to deal with, um, or you just can't get in contact with them, or there's a whole host of issues that could come up with loan servicers. But yeah, if you cannot come to a solution by yourself early on in the process, like do not wait like a week before your maturity and try to ask for an extension. Like be way out in front, like at least 90 days in front of this thing. Um, if you're not getting a response or not coming to an outcome that works, then yeah, I would definitely reach out to some of those people.
now you've got your eighth. Is it the eighth year of the old Capital
Eighth
Conference?
year, yeah, eighth
Man,
year of the
I've
conference, yeah,
I've spoken a few times. I think 3 times, and
yeah.
it's coming up in October again. Do you guys have a theme this year? Are you guys focusing on a specific topic
I
or?
I think the theme is hope. So the theme is hope, and You know, I think a lot of people need uh some positive news. So I'm gonna try to stay on the positive side of everything that's happening. That's why my webinar this month is called A New Cycle, because there, if you know, in comparison, like I just saw a clip, um, and I think it was like 8-figure losses. It was either 8-figure or 9-figure losses on office buildings
Yeah.
that people have taken this year. And like we feel it's like so bad in multifamily, but it really isn't that bad, right? In comparison. And so I think this year is really focused around hope and focused around, I mean, we're going to have some presidential stuff, but we're hosting at the Bush Library in Dallas. But yeah, I mean, I think, you know, there really isn't, I feel like, as many events like in 2021, maybe not 20, but 21 and 22, like there was an event a week. And so a lot of times when we put on an event, like it's a lot of work, everyone's got to come together. But then like coming after it, like you're so energized and like you've just got so much more momentum. Just talking with other people who are going through similar things that you're going through. Like, because like in 21, like if you open Facebook, I mean, you saw a new closing posted every hour.
Yeah.
Like it was just like I haven't seen a new closing posted like in months. Like it's just, yeah. So it's just trying to get everyone back together and you know, help people where we can.
Yeah, you guys have usually a tremendous turnout. You have a great
Yeah.
party the night before. So it's October
Yeah.
9th and 10th. Tell folks
That's right.
why, what are they gonna get out of attending? Why
Yeah.
should somebody come?
Yeah, I mean, the first night is really just a happy hour for everyone to get together and just catch up with people, hang out. And then on Thursday is a full day event. So we bring in, I think what's different about this one is that it's pretty focused in on Texas. So, you know, like if you're interested in investing in Dallas, Austin, San Antonio area, like the brokers are there that represent deals. Like I don't know if I usually do like a what's the deal segment. I don't know if I'm going to do that like live with some of these guys this year. And then we're going to talk to lenders. So we're going to talk about, you know, Fannie, Freddie, Bridge. And then we're also going to bring up some other people who are like talking about their modifications and what they're getting approved, because a lot of this is hush hush, right? It hasn't, like, nobody really talks about their loan modification, their capital calls and things like that. So we're going to try to open up that box a little bit. And then the second half, Julie, who's here, she's going to be doing more of an asset management panel with operators to talk about, all right, so yeah, we don't have as much capital. How are you still keeping occupancy there in today's market? And then we're also going to have GPs at the end just talk about, you know, raising capital in today's environment, but then also how they're looking at new deals as well.
Oh, well, it's gonna be great.
Yep.
Premier Law Group will be there again. So it's oldcapitalconference.com. I think I dropped the
That's
link
right.
in the
Yep.
chat. So oldcapitalconference.com, October 9th and 10th in we're in Dallas, is it? Is in we're in
So
Dallas. In Dallas. In
yeah,
Dallas,
it's in
Texas.
Dallas. Yeah. Yeah. So it's the happy hour is up in Addison, and then the actual Bush Library is right near SMU, sort of near downtown.
Awesome, man.
Yep.
Wait, look, I know, even though you may not be busy with the origination, I know you're super busy with the refinance, especially with all these bridge loans coming due. So I really, really appreciate you on behalf of the entire community for stopping by and spending 45 minutes with us, almost 50 minutes with us. So thank you, James. And we'll see everybody next week. I'll stick around for maybe a 5 or 10 minutes if you guys have legal questions, as always. I'm gonna keep the Q&A going. But James, everybody give James a virtual clap. And thanks for showing up, bud. Appreciate it.
All right. Thanks a lot, Mauricio. See you guys.
If you'd like to join us live on these episodes and have a chance to get your specific question answered, you can simply go to realestatesyndicatorlive.com and register to be live on the show. Hope to see you then.